Hi, this is a very different video format to what I usually do. Usually I edit a lot, usually I add a lot of effects. This thing has no editing. This is simply just rolling the camera, being a bit less information dense, but hopefully also being a bit more approachable to a degree. What I want to talk about in this video is about this controversial topic of Ponzi schemes, especially Ponzi schemes in the crypto universe, because Ponzi schemes, this term gets thrown around like there's no real definition. So whatever is failing, whatever crypto project is failing, seems to be a Ponzi scheme. People call FTX a Ponzi scheme. FTX failed, but FTX wasn't necessarily a Ponzi scheme, in my opinion. There is a strong difference between a failing crypto project and a Ponzi scheme. And in the early days, people called Bitcoin a Ponzi. Now, not that often anymore because Bitcoin is established. But I think there's actually a fundamental mechanical difference between, say, something like Bitcoin and, say, something like a strong block. Okay? What's the big difference between, say, Bitcoin that can crash 70, 80% and then afterwards recover again? What's the difference between that mechanically and strong block that goes down by 70, 80, 90% and then continues down 95, 99, down 99.99999%? What's the fundamental difference? The difference is inflation, token inflation. And the token inflation is a result from the return expectation of the system. So let me explain. When you get into any investment vehicle, you personally, of course, have an expectation, right? You think, okay, maybe this property that I buy will go up by like 10 or 20%, but nobody is guaranteeing this to you. Same for Bitcoin, right? You buy into Bitcoin and you hope that in 3, 4, 5 years, it's at $100,000. But it's not like you buy Bitcoin and somebody tells you you will get 0.5% guaranteed return, right? That's not the case. With Strongblock, for example, that was the case. You bought a note for 10 tokens, and then you got 0.1 token guaranteed back every day. So after 100 days, you guaranteed have the same number of tokens that you invested, and then you keep on getting the same return until infinity. So after 200 days, you made a 100% ROI, right? You have now suddenly 20 tokens. So what's here different? For Strongblock, you got 0.1 tokens being minted, created out of thin air every day for every holder of a node. So the number of tokens increased with adoption, so to speak, and with the duration of how long a node had been held. This is not true for Bitcoin, right? For Bitcoin, the inflation is fixed and it gets lower and lower over time as well. Whenever you have a return expectation that is fixed, that cannot be modified due to demand and supply, then you always introduce instability in the system. So, for example, with Terra Luna, right? You had the Anchor protocol, and the Anchor protocol guaranteed 20% return on stablecoins, on the UST stablecoin. Now, what happens when you want to convert those stablecoins into something else, but that something else that you want to convert into didn't grow as quickly, right? Maybe the balance of that something else where other people bought this from, it didn't grow that quickly. Then at some point, the imbalance is too strong that the thing will depack, right? That whatever is compounding goes down in price. And that's then what we see with Strongblock. That's then what we saw with the depack of UST. So the fundamental difference, if we really zoom out, the fundamental difference between a Ponzi scheme and a regular investment asset is not necessarily that you are profiting from other people coming after you. That's actually always the case, right? When you buy Bitcoin today at a lower price, and then a lot of people come after you to buy it, and then you sell it, you profited from the people that came after you. So that's not necessarily the difference. The difference is the fixed return expectation that gets fulfilled no matter what. That's the difference, because that expectation has to be held. And when the system doesn't grow at the same pace, then the thing collapses. In other words, a Ponzi scheme is as stable as its relationship to its promise returns relative to its user growth. When the promised returns of a Ponzi scheme are 100% every 3 months, then the user base has to double every 3 months. The capital base has to double every 3 months. If that doesn't happen the case, if that stops at some point, then all bets are off. Then the whole thing goes down rather earlier than later. So with strong block, we got this with compounding with a relatively stable price. We had this with Hoard as well, with a lot of these node projects. We always have this return expectation. Now, there are new financially engineered systems that haven't yet collapsed. And because it hasn't yet been collapsed, it is more controversial to talk about them as Ponzi schemes. But let's talk, for example, about elephant money, right? A video that had been relatively well spread within YouTube because of all the engagement by the community. So once a lot of comments happen below a video, then YouTube pushes that further out. So that happened with the elephant money video. And of course, I am still very skeptical of that. Elephant money is a web of different schemes. So you've got the elephant token, which has a buy and sell tax of 10%. You've got futures, which basically work like Hoard. You pay in your deposit, you get a fixed return out. You can never withdraw your deposit. You're basically paid by your deposit every day. You're hoping that more people come after you. Same thing. Plus there's NFTs. So there are a few different systems that are interconnected with one another, making very fancy tokenomics, making this whole system very hard to measure, as in its stability is very hard to measure. It's very hard to say when the pressure on this thing is too high that the growth does not match anymore the expectation of the growth. With elephant money, it's a bit different because we do have this classical Ponzinomics there with the futures product, or we also have less classical things, right? We've got the buy and sell tax, a bit of reflection going on, a bit of token burn going on as it's now being transferred to this whale wallet that never takes out a lot of tokens. The problem with elephant money is the very constant price increase. So there's pretty much no day where elephant money tokens lose value. They gain value every day, 1, 2, 3% roughly. It fluctuates slightly, but when you look at the chart, it goes up very, very straight. There's like no way you can time that asset wrongly as long as the show goes on. As long as the music is playing, this chart doesn't go down. But once the music stops, the chart goes down, right? The chart collapses very fast. The issue is that when you have an expectation set by the past that this token appreciates every day by 1 or 2%, and then that stops suddenly because there isn't enough capital inflow to support this 1 or 2% increase. What then happens is you get a bit of a break in the chart, right? Let's say it only goes down by 10%, right? Something with that market cap, that risk should be super justified, right? It can easily go down by 10%. Every asset should be allowed to go down by 10%. But if you've got a history of several months of never ever going down by several percentage points, if you're always going up, 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 then if that one day hits where there's not enough inflow, then the panic selling starts. Because then it's not anymore business as usual, right? Then everybody gets out very, very quickly. In other words, the new money that flows in this whole system has to grow super, super quick now. This thing has to grow by 1% every day. And yeah, that's a problem, right? So That makes the difference between a cryptocurrency that has long-term sustainability or an asset that you can be held over the decades, right? Be it stocks, be it houses, be it Bitcoin, versus a Ponzi scheme, something that is actually in many jurisdictions illegal. Now, there are different ways to think about this, right? There is the one way to think about this. Okay, just stay away from all of this, because once you identify these things, right? Once you identify promised high returns, you simply just stay away, don't do anything. What you can also do, and this is the potentially unethical part, I think it is fine sometimes, is you can still try to profit this in a way that you try to estimate when does a Ponzi collapse. And with the blockchain and with all of that data, there's actually the possibility to do this, right? There's a possibility to measure what are the monetary inflows, what are the monetary outflows, what are the promised claims, what are the claims that haven't yet been taken out of the system. There is a way to quantify things. This is how then I figured out, when you just look back at this channel, when the Horde crypto project collapsed. I figured this out within 1 to 2 weeks of a buffer. So I could pinpoint this very, very well, because I could see how fast is money flowing in, how fast is money flowing out because of the promised fixed returns. And once there is this swap, right? Once this clicks and there's more flowing out than flowing in, then the treasury, so whatever capital already flew in, is constantly shrinking. And then you simply just have to anticipate, okay, it's shrinking at this kind of a rate. So this is the lifetime of that Ponzi. So you can actually do this. And when you've got that knowledge and you don't have the ethical problems dealing with these systems, then you can say, okay, that thing is probably going to survive for another 3-4 months. I simply just play the game for the next 1 or 2 months, take that profit and say bye-bye, right? That is possible. If you want to do this or if you don't want to do this, is up to you. But the main thing is, if you consider doing it, that you actually do make that research. You do analyze, is there a treasury that's going up and down? How fast are the inflows? How fast are the outflows? How much outflows are we expecting? When does this point in time happen where this swaps and the whole thing is rather contracting than becoming more stable? Most people, 99.9% in those systems, don't do this. But if you want to be among those very, very few winners, you either do that, or you simply just adopt these systems super, super early when you know there will be 80, 90% of the entrants coming after you, right? This is a bet of you getting money from people that join the party late. And you have to determine, basically, with that analysis, at what point in time does the music stop playing? And with blockchain, there is the possibility actually to quantify this and to figure that out. It's not easy, right? It does take work. You do need to learn the technical skills, but it is possible. The less complex the system is. For Elephant Money, for example, it's very complex because you've got several schemes being connected to one another, transferring flows against each other. So it's not that simple. I personally haven't yet been able to pinpoint that exact time for Elephant Money. There's only kind of rough ideas one can have. For example, when you just look at the relative size, right? Elephant Money is now, I think, in the top 5 holders of wrapped BNB and of BUSD. When you already know that, then you know it's definitely not a small project, right? On the Binance Smart Chain, it's now one of the largest projects, at least in terms of assets being held in those 2 main categories on the Binance Smart Chain. So with this, you can like rough see, okay, it's probably not going to like 10x from here. That's my personal opinion. I haven't run the numbers on the stability on this because, yeah, I haven't yet figured out how to match all of these flows within the different tokenomics schemes. But that's roughly what you got to do, and it's roughly what you have to consider. The positive thing, if you want to be in that scheme, is that the break-even period isn't too far out. So with Ford, right, you had to wait 100 days until you break even. If you buy the elephant token, right, you're down 10% when you buy, you sell, you are down another 10% when you sell. You can get a little bit less fees when you use like affiliate links and stuff, when you use the website. So you're only down like 8.5%, I think, with each purchase and sale instead of 10. So you have a bit less of that reflection fee for you. But still, right, when it grows by like 1 or 2%, you've got a break-even point after roughly 1 to 2 weeks, rather 2 than 1 week. So after 2 weeks, you're already break even. Then afterwards, you're making money. So if you think, for example, that the likelihood of this elephant money, after your analysis with all of the claims and the inflows, if you think that the likelihood of elephant money staying alive for another month is above 50%, if that's what you come to the conclusion with, right, after running all of this, if you think the likelihood of this staying alive for another month is more than 50%, then you should take the bet, because the price itself appreciates by 60-70% per month with that current growth. If you think that in 4 weeks the thing implodes, well, then obviously, like when you think it implodes already after 2 weeks now from here, then you obviously should not buy this, right? Because then you don't get back the tax that you pay in. So yeah, crypto in its current state, in the bear market, where nothing is expanding, where it's only the current players, very few new people come in. If you want to make profit, you have to take it from somebody else. It's player versus player. And in Ponzi schemes, it's slightly different than with other cryptocurrencies. It's not just trying to buy low and sell high. For Ponzi schemes, it's about timing when the music stops. And there is ways to do this. It's simply just not easy. Most people don't do it. Most people just follow their gut feeling. And of course, you should not just fall prey to the marketing of these schemes, right? We've seen a lot of that in Strong Block and in Horde, etc. Feel free actually to check out those videos. They're a bit older, but check these out. Check out the comment section. Just have a look at what the comment section in those videos say. The Strong Block video, I think, is 1.5 years old now, roughly. Just have a look at that community. This was the first time I actually experienced a community being that hostile to a creator. And I wasn't even like completely dumping on the project. I was explaining how it will collapse, but I wasn't using any harsh words. But I did definitely get very harsh words back in return in the comment section. Feel free to check it out. And I was defending myself in that comment section as well. So yeah, these are the words for today. Completely raw, completely uncut. Let me know what you think about this kind of a format. I will obviously also look at the analytics, how the view time, how the retention on such a video is, because right, that's the problem with YouTube. If people click away, then of course it won't be spread very far. But if there's at least like a core minority of viewers that enjoy this way more, then I might do this more often. So see you on the next one. Cheers.